Most people spend their whole lives believing taxes are a bill. I learned a long time ago that for people who understand capital, taxes are also a map. And if you read that map correctly, the government tells you in plain language what it wants built, what it wants funded, what it wants expanded, and what it is willing to reward. That is the part most people miss. They think the wealthy discovered some secret offshore trick or some magical loophole buried in the shadows. In most cases, the real secret is much simpler and much more uncomfortable than that. The tax code is not neutral. It is a giant system of incentives. It rewards behavior the government wants more of, and it punishes behavior it wants less of. If you simply earn income, spend it, and then hand over whatever is left after taxes, you are playing defense your whole life. But if you direct your money into the activities the system is designed to encourage, the system begins to work with you instead of against you. That is why I want to make one thing very clear. At the beginning, I am not talking about the obvious vehicles everybody already knows. I am not talking about the basic conversation around a 401k, an IRA, or even an HSA. Those matter. But they are not the real dividing line between people who merely save money and people who build durable wealth. The real dividing line is whether you understand this one strategic truth. You can either keep paying into the system year after year, or you can position your capital where the system is already paying people to go. That payment does not always arrive as a check with your name on it. Sometimes it arrives as a deduction, sometimes it arrives as a credit, sometimes it arrives as depreciation, sometimes it arrives as favorable treatment on the way in, favorable treatment while you own the asset, and favorable treatment on the way out. But make no mistake, it is still payment. And the people who get rich are very often the people who stop asking, how do I lower my taxes a little, and start asking, what does the code reward so aggressively that it can change my entire compounding path? Once you see the world that way, a lot of things that look random begin to make sense. You begin to understand why so many rich people own businesses. You begin to understand why real estate keeps producing fortunes across generations. You begin to understand why certain energy investments attract serious money even when the average person has barely heard of them. The code is trying to direct capital. The great game is learning to move with that current instead of fighting it. I have spent most of my life looking for structures that allow me to keep more of what I earn and compound it longer. I do not admire complexity for its own sake. I do not enjoy paperwork. I do not romanticize tax planning. I simply know that every dollar you do not needlessly surrender is a dollar that can buy another asset, fund another opportunity, or sit in another compounding machine for another decade. People work very hard to earn money. Very few work equally hard to understand how money is treated after it is earned. That is a costly mistake. So let me give you the framework as plainly as I can. Every major tax break exists because the government wants something badly enough that it is willing to subsidize the people who provide it. It wants jobs. It wants housing. It wants domestic production. It wants energy. It wants investment. It wants economic activity that supports the larger machine. And when it wants those things badly enough, it does not send a speech. It sends a tax incentive. That incentive can take the form of a deduction against income, a credit against taxes owed, or special treatment that lets you delay, reduce, or sometimes largely avoid taxation if you structure things properly. So the intelligent move is not to cheat. The intelligent move is to notice what is already being rewarded. That is where the richest investors operate. They do not spend all day complaining about the code. They study where the code is generous. Then they build there. If you want to understand the highest value paths inside that framework, there are three broad buckets that matter more than almost anything else: business investing, real estate investing, energy investing. I want to walk through them in that order because the progression itself matters. The first path creates economic activity. The second path creates and controls housing and productive property. The third path supports one of the most politically and economically sensitive systems in the world. And the further you move into those buckets, the more you start to see how the code is not simply collecting money. It is steering the economy. Let us start with the first path, owning a business. If you forced me to identify the single most powerful tax deal available to ordinary Americans who are willing to think and act like owners, I would start there. Business ownership is one of the fastest legitimate ways to build wealth because it sits directly on top of what the government wants. Most small businesses create jobs. They stabilize local economies. They generate spending, wages, and downstream activity. Without them, unemployment would surge, growth would weaken, and entire communities would hollow out. So the code does not merely tolerate business owners, it actively favors them. That is why when you look at many of the richest people in the world, you usually find that somewhere in the structure, directly or indirectly, they own businesses. They are not taxed the same way a simple wage earner is taxed. A wage earner usually feels the tax system before he ever touches his own money. The money arrives, taxes are already embedded, and then life begins from a diminished base. A business owner lives in a different world. A business owner earns revenue, subtracts legitimate costs of operating and growing the enterprise, and pays taxes on what remains. That difference sounds small until you understand what it means across years and decades. It means one person is taxed on gross economic effort, the other is taxed on net economic residue. That is not a detail. That is a structural advantage. And once you understand that, you stop seeing a business as only a source of income. You start seeing it as a tax architecture. Now, I want to be careful here. People hear something like that and immediately jump to fantasies of fake businesses, personal expenses disguised as deductions, or some other childish game. That is not what I mean. I mean legitimate activity, real operations, real intent, real risk, real effort, real economic purpose. That is what the code is designed to reward. Even at the very beginning, the system gives you clues. Suppose you are considering starting a business, even as a side venture. Maybe it grows, maybe it does not, maybe it becomes something substantial. Maybe it remains a modest but useful enterprise. The moment you begin researching, investigating, organizing, and launching that venture, the code starts offering relief. There is a startup and organization cost deduction that can allow you to write off up to $5,000 of certain costs tied to researching and investigating a new business, and another $5,000 tied to formation and organization once it is legitimately launched. Think about what that means. Before many people have earned a single dollar, the code is already signaling. If you are serious about creating something productive, I will absorb part of the cost. That is the first clue. The second clue arrives once the business earns money. Small business owners may qualify for a 20% deduction against qualified business income. That means as the business grows, the code can become more favorable than the world of ordinary wage income. So already you have a business that can deduct startup costs, deduct operating costs, and potentially deduct a meaningful portion of business income through the QBI framework. And we still have not reached the part most people underestimate: expenses. This is where the real shift in thinking begins. A great many people live their financial lives with expenses that are purely private and therefore completely dead from a tax perspective. Housing, cars, travel, technology, meals, professional help, software communications, space equipment. They buy all of these things with after-tax dollars because those things live entirely on the personal side of the ledger. But once you operate a legitimate business, a surprising number of costs that are directly connected to operating, marketing, serving clients, delivering work, managing systems, or expanding the enterprise can move into a different category: marketing, advertising, equipment, software, professional fees, certain travel, certain meals, certain vehicle use, in some circumstances, portions of housing used for the business. I am not encouraging abuse. I am encouraging recognition. The same life that looked purely consumptive in one structure can become partially productive in another, and the tax treatment changes accordingly. That is one of the reasons I have always said that ownership changes everything. It changes not only how you earn, it changes how expenses attach to your economic activity. And once capital expenditures enter the picture, the game becomes even more powerful. Consider large businesses for a moment because they make the principle easier to see. One reason enormous companies have managed at times to report very low federal income taxes despite generating significant profits is that they keep reinvesting in the machinery of growth property equipment: warehouses, servers, vehicles, research, development, product systems, expansion, infrastructure. When that capital is deployed in ways the code favors, the taxable income picture can change dramatically. The public sees revenue and assumes taxes should mechanically follow. The investor sees depreciation, credits, timing differences, and strategic reinvestment. The public thinks they made money. The investor asks, how much of that money was directed into activities the code rewards so strongly that the taxable base shrank? That difference in perspective is enormous. It is the difference between reacting to a tax bill and architecting one, and the further you go down that road, the more you realize you can shape your tax outcome through capital allocation. You can choose to distribute, you can choose to reinvest, you can choose to fund growth, you can choose retirement planning, you can choose income shifting strategies where appropriate. You can choose timing, you can choose entity structure. Each decision changes the tax profile. That is why business ownership is not simply an income tactic. It is a control tactic. The person with no ownership is mostly at the mercy of a system. The person with ownership has levers. Now, business ownership is not easy. Most businesses do not become empires. Many struggle, some fail. But from a tax standpoint, there is no serious conversation about wealth building that should ignore the advantage of moving from pure wage dependence towards some form of legitimate business ownership. Even a modest side business can begin teaching you a language the average worker never learns. That language is the language of net income, deductions, capital investment, and strategic control. Once you understand that language, your relationship to taxes is never the same again. But business is only the first bucket. The second bucket is real estate. And if business ownership is the great operating engine of the tax code, real estate is one of its great shelters. There is a reason fortunes have been preserved and expanded through property for generations. The attraction is not only appreciation, it is not only cash flow, it is not only leverage, it is the fact that real estate often allows the investor to enjoy economic benefit while reporting much less taxable income than an outsider would expect. That is where people get confused. They look at a rental property and think in very simple terms. Rent comes in, expenses go out, profit remains. But the tax picture is not that simple because the code treats real estate with extraordinary generosity. Let us start with the basic idea. When you own a rental property, whether it is a house, an apartment building, or commercial property, you are operating in a business. Like environment, income is coming in, expenses are going out, and those expenses are not limited to the obvious checks you write. You may have mortgage interest, you may have property taxes, you may have insurance, you may have repairs, you may have management fees, you may have maintenance and various operational costs. All of those items matter. But the major force that changes the picture is depreciation. This is one of the strangest and most powerful concepts in the entire code. Real estate often appreciates over time in market value, especially well-located productive property. Yet the IRS still allows you to take a depreciation deduction as though the building is wearing out economically over time. That means you can own an asset that may be rising in value while taking deductions tied to its theoretical decline. Think about the beauty of that from an investor's perspective. You may have positive cash flow in reality. You may be building equity. The property may be climbing in value. And yet, on the tax return, depreciation and related expenses can shrink or even wipe out much of the taxable income the property appears to be producing. That is not an accident. That is a policy choice. The code is deliberately telling you if you provide rental housing or productive real property, I will let you recover costs in a way that softens the tax burden. And for many investors, the result is remarkable. They collect rent, they retain cash, they build equity with tenants, effectively helping service debt. And when tax time arrives, the reported taxable income can be little or nothing because depreciation and other deductions have done so much work. That is why real estate has long been described as one of the best tax shelters in the world. But even that is only the first layer. The second layer is acceleration. This is where people move from ordinary real estate ownership into far more strategic territory. Through a process called cost segregation, an owner can analyze components of a property and accelerate depreciation on parts that qualify for shorter lives, that can create substantial first-year deductions through mechanisms such as bonus depreciation and, where applicable, Section 179 treatment on qualifying components. The practical effect is what matters. Instead of spreading so much of the tax benefit slowly over a long period, you can front-load an enormous portion of it that changes the math on a property of meaningful size. The deduction can become so large that it shocks people who are not familiar with the structure. A cost segregation study on $1 million property can, in some cases, generate over $200,000 in additional deductions in a single year. Pause and think about that. Some investors put down less than that to acquire the property. In other words, the deduction can be so large that it rivals or even exceeds what the investor feels he truly put at risk up front. And it gets even more interesting when leverage enters the picture. The code generally does not care whether every dollar of acquisition came from your own pocket or from financing. If you lawfully buy a property with debt and the property qualifies, you can still enjoy the depreciation. That means you can use borrowed money to buy the asset. Let the asset produce income. Let the asset appreciate, let the debt amplify the ownership return if the deal works, and still claim tax benefits that soften or delay taxation. Then, if you build equity, you may be able to borrow against that equity without creating a taxable sale. That is another subtle but essential point. Borrowing is generally not income, so a person can watch a property rise, borrow against the value access capital, and postpone the taxable event that a sale would create. And if later the owner decides to sell, there may be opportunities to defer capital gains through a 1031 exchange by moving from one property into another qualifying property. Now, you begin to see why real estate has become a repetitive wealth machine for disciplined investors. Buy productive property, use leverage carefully, collect income, take depreciation, accelerate deductions where appropriate, build equity, borrow when useful, exchange when needed. Repeat, the machine is not magic. It is policy, and the people who understand it can spend decades building wealth in a form that is unusually tax efficient compared with the life of a pure salary earner. That does not mean every real estate deal is good. Plenty are terrible. Bad locations, bad financing, bad management, and bad judgment can destroy returns quickly. But again, we are talking about the architecture of incentives. The architecture is extremely favorable. It rewards ownership. It rewards housing supply. It rewards development and improvement. It rewards the patient investor who understands time, leverage, and tax treatment. The average person looks at property and sees rent. The serious investor looks at property and sees rent, leverage, depreciation, equity growth, refinancing, optionality, and gain deferral. That is a very different lens. And if you can learn to look through that lens, you stop asking whether real estate is simply a side investment and begin asking whether it is one of the central engines through which wealth is quietly protected. Now we come to the third bucket, energy. This is where the conversation becomes more specialized, more selective, and in some cases more dangerous if handled carelessly. But it is also where some of the most aggressive incentives in the code appear, because the stakes for the country are so high. The world runs on energy. That sentence sounds obvious, but most people still underestimate what it means. Energy moves goods. Energy powers manufacturing. Energy heats and cools buildings. Energy sustains transportation networks. Energy sits underneath the cost of almost everything. When domestic production is weak or when energy prices surge, the consequences spread everywhere. Shipping costs rise, input costs rise, consumer prices rise, entire industries feel pressure. In extreme conditions, recessions can follow. So the government has a strong incentive to encourage domestic production, especially in politically and economically sensitive sectors such as oil and gas. And when the government wants more of something that badly, the incentives can become unusually rich. This is where sophisticated investors start paying attention. If you invest in a qualified company engaged in active drilling operations, the code can allow a very large portion of that investment to become deductible in the first year. In some cases, up to 85% of the investment may be tax deductible up front. That is not a trivial benefit. Imagine investing $100,000 and receiving an $85,000 paper loss on a K1 that may be used, subject to applicable rules and circumstances to offset other income. That is the sort of treatment that immediately separates routine investing from strategic tax-oriented investing. Why does the code allow something that generous? Because drilling is expensive, risky, operationally demanding, and nationally important. Again, the code is not behaving randomly. It is recruiting capital. There are a few major engines behind this. One is the treatment of intangible drilling costs. In most businesses, intangible costs do not receive such favorable immediate treatment, but in drilling, costs tied to labor, fuel, chemicals, hauling, site work, and similar operational activity can often be expensed immediately rather than capitalized and recovered slowly over time. That accelerates the tax benefit dramatically. A second engine is depreciation on the physical side of the enterprise equipment, machinery, infrastructure. Even the wells themselves can generate depreciation. Base tax benefits, and the investor can share in the economic effect of those deductions. So now you have a structure where both the intangible and the tangible sides of the operation may receive powerful treatment. That is already unusual. Then the story improves further on the revenue side. Certain energy investments may also benefit from depletion, related tax treatment, including the possibility that a portion of the income can be shielded through depletion allowance. In simple terms, not all of the revenue may be taxed the same way an outsider would expect. So you can have a situation where the investor receives a major deduction when entering favorable treatment while the investment operates, and then ongoing cash flow that is not fully taxed in the ordinary way. There are not many places in the code where you see that kind of three-stage generosity. That is why these opportunities attract high net worth capital. But now I need to slow you down, because this is where the romance of tax strategy can become dangerous. The existence of a tax benefit does not eliminate risk. Oil and gas investing is not a toy. You are not opening an app and buying a broad market index fund. You are often dealing with private structures, specialized operators, operational risk, commodity risk, regulatory risk, illiquidity, and a level of complexity that absolutely requires adult supervision. In many cases, these deals are aimed at accredited investors. In many cases, access is limited. In many cases, the operator matters more than the story, and in all cases, the deduction should never be the only thing you study. Bad economics wrapped in good tax treatment is still bad economics. I have seen many people become intoxicated by the promise of immediate deductions and stop asking the questions that actually protect capital. Who is drilling? What is the operator's track record? How is the deal structured? What assumptions drive return? What happens if energy prices fall? What happens if production disappoints? What are the fees? What are the exit constraints? How does this fit into the investor's total financial picture? Without those questions, the tax benefit becomes bait. And bait is expensive. So while I respect the power of energy investing inside the code, I would never approach it casually. This is an area where a competent CPA and a serious investment advisor are not luxuries. They are safeguards. Still, the existence of these incentives matters enormously because it proves the broader thesis. The code is a reward system. It rewards people who put capital where the government wants capital to go: business, real estate, energy. Those are not random categories. They are three of the clearest examples of how the state tries to shape behavior through tax treatment. And once you understand that, you stop looking at taxes like weather. You stop acting as though April is an annual surprise. You stop assuming the only strategy is to earn a little more, stuff a little more into standard retirement accounts, and hope the pain feels smaller next year. That is not strategy. That is endurance. Strategy is recognizing that the tax bill is often a lagging indicator of the economic structure underneath your life. If your structure is purely labor-based, your options are narrower. If your structure includes ownership, your options expand. If your structure includes assets the code heavily favors, your compounding can change dramatically. And that is the deeper reason this conversation matters. It is not just about saving taxes this year. It is about deciding what kind of economic life you are building. Are you going to remain someone who is perpetually taxed before he can think? Or are you going to become someone who allocates capital with intention? Are you going to stay in the category the system harvests most easily? Or are you going to move closer to the categories the system subsidizes most aggressively? I am not telling you every person should immediately start an oil and gas venture, buy 10 properties, or form a business on Tuesday morning. That would be foolish. I am telling you to notice the pattern. The pattern is the edge. The code rewards production. The code rewards ownership. The code rewards risk, bearing in selected areas. The code rewards the people who help create jobs, build housing, deploy equipment, and support critical domestic output. That is the message hidden in plain sight. And once that message becomes clear, your next step is not to chase every deduction. Your next step is to examine your own life and ask where your capital, time, skill, and temperament actually belong. Some people are built to own and operate businesses. Some are better suited to patient property ownership. Some have the sophistication, risk tolerance, and advisory support to evaluate specialized energy deals. Different paths fit different people. But the principle underneath them is consistent. Taxes are lowest where the government's priorities and the investor's capital overlap. That is why I have always preferred assets that do more than merely sit there. I like assets that produce. I like structures that allow retained earnings to remain productive. I like decisions that improve both economics and tax treatment at the same time. I do not separate those questions. I treat them as part of the same puzzle. Most people treat taxes as an afterthought. I treat them as part of capital allocation. That does not mean I make decisions solely for tax reasons. Taxes should not turn a bad investment into a good one in your imagination. But when two opportunities are economically sound and one of them is dramatically more tax efficient, ignoring that difference is simply careless. The best investors I have known were not obsessed with gimmicks. They were obsessed with after-tax return. Pre-tax numbers can flatter you. After-tax numbers tell the truth. That is why I want to end this with a harder point. You do not build explosive wealth merely by earning more income. You build explosive wealth by combining earnings, asset selection, tax efficiency, and long-term compounding into one coherent system. If one part of that system is weak, the whole machine slows down. A person who earns well but ignores taxes leaks capital. A person who saves on taxes but buys weak assets wastes the advantage. A person who buys good assets but fails to hold them long enough interrupts the compounding. A person who chases deductions without understanding risk can destroy himself with sophistication. The goal is not tax minimization in a vacuum. The goal is intelligent after-tax compounding. That is the real playbook. And if you understand that playbook, you stop envying people who seem to pay very little tax and start studying the structures that made it possible. Usually the answer is not hidden. Usually the answer is ownership. Ownership of a business, ownership of productive real estate, ownership, direct or indirect, in activities the system urgently wants funded. The average person asks, how do rich people pay less? The better question is, what are rich people doing that the code rewards? That is the question that changes behavior. That is the question that changes portfolios. That is the question that changes lives. So here is the test. The next time you look at your taxes, do not begin by asking how much you owe. Begin by asking what your current financial structure is training you to become. Is it training you to stay a taxpayer first and an owner second? Or is it training you to become the kind of person the code quietly supports because you are building what it once built? One path sends money out and hopes for leftovers. The other path turns incentives into assets and assets into compounding. Most people spend decades on the first path because it feels familiar. Wealth is usually built on the second path because it is strategic. The IRS is not literally handing out free money to everyone with a pulse, but in a deeper sense, it is paying people every day to build in favored directions. The tragedy is not that the system is unfair. The tragedy is that so many people never learn what the system is rewarding until they have already spent half their lives standing in the wrong line. I would not stand in that line. And if I were you, I would not either.